Hi everyone, my name is Sandiswa and welcome to Tax Shelter. If you are a small business or an individual who would like to learn how tax works in South Africa and to get some tax tips, then this is the channel for you. Today I'm going to be talking all things 10 over tax. What is 10 over tax? Who is it for? And how can you make it work for you? Now, firstly, what is 10 over tax? Okay. 10 over tax is a simplified tax system that is used in order to help micro businesses. One of the things that small businesses struggle with in South Africa is because there are too many taxes. We have income tax, we have VAT, we have pay as you earn, we have provisional tax, which is part of income tax, by the way. We have estate duty, we have donations tax. There's just way too many taxes to actually deal with, especially as a small businesses who in most cases does everything. You are the accountant, you are the operations person, you are the finance department, you are everything, but you're one person. So what SARS decided is, you know what, let's just come up with a system that's going to help small businesses and small business owners to be able to get a simplified tax system that at least so that at least they don't have to deal with all these many taxes that are available in South Africa. Yes, for a bigger business that can afford an accountant, then it's fine. But for small businesses, it's a lot to be dealing with. You'll find yourself having to go to SARS all the time for the different taxes, and also the admin and keeping up with everything. It's very difficult, especially for someone who doesn't have a tax background. So that is why SARS introduced 10 over tax. Now, which taxes do you need? Which taxes does 10 over tax replace? Well, 10 over tax replaces income tax, VAT, provisional tax, capital gain tax, and dividends tax. That's a lot, guys. That's 5 types of taxes replaced by one. VAT, income tax, sorry, not pay as you earn. It's VAT, income tax, provisional tax, capital gains tax, and dividends tax. 10 over tax is calculated by applying the rate to the 10 over tax of the micro business. In other words, to the sales. In simple terms, you apply a tax rate to the sales of the business. 10 over is sales. And that's why this is called 10 over tax. It's sales tax. You apply the tax rate to the sales. Remember, with a normal business, you apply the tax rate to the net income before tax, which is, this is after sales minus expenses, minus finance income, and then you get your net income before tax. Normal businesses, that's where you apply your tax rate, but in this, the 28%. But in this situation, 10 over tax is applied to the 10 over, which is the sales. Now, I will leave a 10 over tax table on the description so you can see for yourself, right? Now, who is this for, 10 over tax? Well, 10 over tax is for sole traders, partnerships, close corporations, private companies, and cooperatives. So it's almost for everybody, if I can put it that way. So if you are one of these, if you're running a business under one of these as a sole trader, partnership, or a close corporation, a private company, or cooperative, then you can apply 10 over tax to your business, right? Now, unfortunately, with 10 over tax, SARS still has not figured out to have it submitted via e-filing. I think mostly because there isn't a lot of companies that are taking advantage of this 10 over tax. There isn't a lot of companies, or I think maybe companies are turned off by the fact that this is applied on the sales. Unfortunately, you cannot submit 10 over tax over e-filing, and it might be because there's a small number of people that are actually taking advantage of 10 over tax, and so maybe SARS is not yet ready to invest in that at the moment. So in order to submit 10 over tax, you have to go to the branch yourself, or you have to complete the 10 over tax form and then post it to SARS. I would advise people to go to the branch themselves. Obviously, the branches are still closed right now, so you'd have to go when the branch is open. Now, if you are using the turnover tax system, what records should you be keeping? Unlike with other tax types, turnover tax requires less record keeping. However, you still need to keep records of the following: the amounts received, the dividends declared, a list of assets with a cost price of more than 10,000 Rand at the end of the year, as well as a list of liabilities exceeding 10,000 Rand. Guys, come on. Compared to all the records that you need to keep for the normal taxes, this is absolutely nothing. So if you're a micro business and you qualify to take advantage of this, then I would really advise for someone to take advantage of it. Obviously, you need to check if you're going to benefit financially from it. In other words, if you can, just do a quick calculation. If you're using the normal tax system, in other words, if you're using the normal tax system where you pay 28% of from your net profit, or if you're using the turnover tax where you use the turnover tax tables that I'm going to leave on the description box to see if which one is more suitable for your business. Obviously, taking into account the admin and the time and the expenses that come with using the normal tax system, because you need in most cases you need an accountant, especially if you are registered for these many taxes. You need an accountant or a tax practitioner. So a turnover tax, you need to keep, you need to, with the normal taxes, you need to know your incomes, you need to know your expenses, and a whole lot of other stuff. Keep track of all your assets and all of that stuff. With the turnover tax, you need the amounts received. That obviously makes out your sales, right? And then you need the dividends declared. And then you need a list of assets that are more than 10,000 Rand at the end of the year, and a list of assets that are more than, a list of liabilities that are more than 10,000 Rand at the end of the year. Now, what are the disadvantages of turnover tax? The only disadvantage of turnover tax that I can think of is the fact that you can't do this on e-filing. You have to go to the branch or you have to post. That's the only disadvantage I can think of. Obviously, like I said, you need to make sure that you calculate if you're going to benefit from turnover tax before you actually go and submit using turnover tax. Or if you perhaps are not sure how to do this, then you can consult a professional to do this calculation and comparison for you, right? Now, what are the advantages of turnover tax? For starters, there isn't a lot of record keeping. Like I said, I told you the 3 things that you need to keep a record of, and that's all you need. Ultimately, when it comes down to it, for turnover tax, you just need the sales. You don't need to keep track of your expenses, which is nice. All you need are your sales. And obviously the list of assets and liabilities and the dividends declared. And fortunately for you, dividends are normally declared once in each year in most companies. Now, what is the second advantage for turnover tax? The turnover tax rates, as you will see on the description box, are significantly lower than the standard tax rates. You will see, I will post the turnover tax rates as well as the standard tax rates. You will see this for yourself. In fact, the standard tax rate for companies is actually 28%. You can compare that with the tax rates for turnover tax and see for yourself. And that is about it, guys, when it comes to turnover tax. If this has helped you, then I'd really appreciate it if you can like the video as well as subscribe to the channel if you are happy with it. And if you would like to get notifications, then click the notification button. Thank you for listening, and until next time.